So I guess we can start now. So again, like good evening all and welcome all to today's webinar of 401k rebalancing and 401k mastery. So today I and Harshil are going to talk more about one of the important investment avenues in the US to build the retirement corpus. So according to the Vanguard's data, nearly 80% of the people or population in America depend on 401k for the retirement. That's their golden years. So hence, this is one of the important avenues for the US NRIs and people who are planning to go to US for the studies or work and so on. So we'll start with basics. So one thing that triggered us to start with this webinar was 63% of Americans are confused about the 401k retirement plans. Being in America, if people are already confused about the 401k retirement plans and the workings and so on, so it's obviously going to be a bit difficult for the NRIs who are going to be traveling there and settling there and starting a portfolio there and so. So hence we thought of this is going to be one of the important thing that people have to be aware of and yeah, help out in their building a good corpus for the retirement and golden years. So let's begin with basic questions. So what is a 401k plan? So actually 401k is a retirement savings account, or in short, it's an employer sponsored retirement investment plan. So from this, what happens is it's like the employer would direct a certain portion from your cash flow on a monthly basis, and it would put towards your 401k portfolio, which in turn actually reduces your taxable income and results in nice tax deduction that specific financial year. So since the 401k allows you to save for your retirement with tax deductible in contribution, which results in paying less taxes today and also having more money putting towards your retirement goal. So however, 401k, you will eventually have to pay taxes during your retirement. So actually there are two types of 401k accounts, that's Roth 401k and traditional 401k. We'll talk more about that in the upcoming slides. So just for a basic slide, like in India, we do have EPF, Employee Provident Fund. From our payslip, we are contributing something towards the EPF. Similarly, in US, from the payslip of like American employees or NRI employees, certain amount is contributed and redirected towards a 401k bucket that's specifically mapped towards a retirement goal. In this, the employees are actually given a freedom to select various investment alternatives such as mutual funds, ETFs, stocks and commodities at certain cases and so on. So it's going to depend and differ from employee to employee. So it's like you might ask, it's like are 403B and 457B plans similar to 401k plans? Actually, yes and no. It's similar to the 401k plans, as in it's a tax deferred retirement plan. But what's the case is 403B plan is eligible for the employees or the people or professionals that work at public schools, colleges, and universities and other non-profit organizations. Whereas 457B is a retirement plan that's available for only state and local government or certain non-profit organization employees. So that's the main difference in 403B, 457B and 401k plan. But the main crux or the base is the same. It's actually your retirement savings investment avenue that will help you build a good corpus during your retirement. So it's like, what are the main benefits of investing in a 401k plan? So as I said, let's assume it's like you're contributing towards your 401k plan. So whatever amount that you're contributing now, maybe if it is after tax, in your retirement, whatever amount you're going to build up, that's not going to be taxed at that stage. Let's say there's other investment avenue, whereas it's like if you're contributing to this 401k account with pre-tax money, during your retirement, you will be taxed at the whatever corpus you're going to withdraw. So that's one efficient way. So in short, it's like right now, if you are at a higher tax liabilities or higher slab rate and so on, you can contribute towards the 401k plan and actually deduct and reduce your tax liability, because whatever contributions you're making under your 401k plans, it's going to be tax deductible. So as I said, it's going to be tax deferred growth, right? So let's say it's like right now I'm not paying taxes on certain, let's say a Roth 401k account, but I'll be paying taxes at the time of my retirement. So let's say at that time I'll be in a lower or a slightly lower slab rates. That's than what I'm right now. So hence it's a tax deferred growth way. And also it's like one important thing that people are actually not aware about is employer match. We'll be actually cracking down employer match in detail in the upcoming slides. So the ultimate 401k guide. So Roth versus traditional, getting the match, the employer match that I was talking about, maxing out your 401k contributions and diversifying the same, and obviously rebalancing the same. It's like we'll talk all about this in detail in upcoming slides. So starting with Roth versus for a traditional 401k account. So to keep it simple, what's going to be the case is in traditional 401k accounts, the contributions are made with pre-tax money. So let's say if you're earning 100 rupees or $100 actually, in that $20 would be redirected with before paying any taxes to this 401k account. In this case, what's going to happen is it's like in your retirement, you would be able to, you are you will have the tax implication on whatever amount you want to build up. So in this case, it's going to be tax deferred growth. So yeah, as of now, it's going to reduce the taxable income during the year of contribution, and tax payable is upon the withdrawal. So what's going to happen in Roth 401k? So in Roth 401k, the contributions are made post-tax. So in this case, what's happened is it's like during your retirement, you won't be able to have any tax implication or tax liability and so on. So hence it's tax-free withdrawal, and earnings are also completely tax-free on whatever the portfolio value is going to be on that level. So it's like this is going to be more or less suitable for people, those who are expecting during the retirement, actually, they'll be actually in a higher tax bracket. So this is one of the best way. So to keep it simple and to summarize it again, in traditional 401k accounts, your contributions are made with pre-tax money or pre-tax dollars. Whereas in Roth 401k account, your contributions are made with post-tax dollars, and vice versa, it's going to be taxed in your retirement. So moving on to the next slide. Okay, what is getting the match? So it's going to be different for the like different employers and so on, different organizations. So what's going to happen is it's like there are some employers that will provide partial Roth 401k matching. So let's say if you are contributing $20, they'll try to match it up and they'll provide, let's say 3% or 6% of the total match. The employer will also contribute on your behalf. So in short, it's something like getting a free money from the employer. So apart from that, there is some organizations that also provide full for Roth 401k matching. Let's say it's like if you are contributing $20 from your existing monthly cash flow, the employer is also going to contribute and match whatever contributions that you're making up to 100% and contribute towards your 401k portfolio. So these are the two different things. And one thing is this is actually a free money that your employer is going to provide you, and they're actually motivating you to invest and like stay invested with them for a long period of time. And yeah, by providing an employer match. So this is what people are generally not aware about. You can actually reach out to your HR and finance team and figure out what is the employer match that your organization is providing, and then you can figure out it's like what is the best way to make most of it. So let's say if they are providing full Roth 401k match, so it's like what is the max limit of your contribution? Let's say $23,000 per financial year. That you can do the same contributions, and you will be able to get another $23,000 from your employers on the same thing. So hence getting the match is one of the important thing. So as I said, it's like what is the best way to max out your 401k contributions? So right now, the maximum limit that you can contribute for an employee is around about 23,000. So catch up, there's a catch up contribution for those who are more than 50 years or plus. So let's say if you're 51 or 57, you can contribute maximum up to $30,500 and so on in this 401k account. So, and one thing is this is generally actually increased on a yearly basis, considering whatever general inflation is there in the US. Apart from that, it's like combined employer and employee annual 401k contribution limits. So as I said about the match, right? Let's say if you're contributing $23,000 and so on, what's the maximum you can go with the employer also contributing towards a specific thing? So $69,000 is what you can actually contribute maximum on a yearly basis. So this is actually one of the best way to contribute towards your retirement and build a good corpus. So apart from that, yeah, there are a few factors like rebalancing, choosing the right asset class to be invested in, and that's what we'll be discussing in detail in the upcoming slides. So one thing I'm going to recommend to all of you is if you are participating and contributing towards your 401k, try to get your employer matched and try to max out all your 401k contributions, because it's one of the best tax efficient way to invest and compound money at a good rate of return. So that's going to be the strategy. So, okay, this is also one interesting data point. Only 1/3 of the small businesses in US offer the employees the retirement plan options. So nearly half of all the US employees working for a small business. So what happens for the remaining 2/3? So, okay, for that, there's other avenue. So let's say it's like, as I said, what if your company doesn't offer a 401k plan? So there's something called as an individual retirement account. So that is one thing that you can max out and contribute to. That's traditional IRA account. Similar to Roth 401k and traditional 401k, there's something like a Roth IRA, individual retirement account, and traditional individual retirement account. So what we have generally seen so far while dealing and rebalancing and reviewing the portfolios for 401k is, if there's a 401k portfolio with an employer, at times the options provided by the employer sponsored programs are a bit minimal. Whereas in individual retirement account, you have vast option depending upon the broker that you are choosing to and that you are choosing to work with. Apart from that, there are a lot of other investment avenues like simplified employee pension, IRA, health savings account. Apart from that normal investment account, you can just set up a brokerage account and start investing too. So let's say it's like if you're working at an organization or a startup that's not providing a 401k investment avenue or a 401k plan. So there is no specific rule, right, that you have to save for your retirement in a retirement account itself. You can still compound at something like a brokerage account. You can set up an individual brokerage account, contribute towards it, and set up same thing. So in this case, it's like what happens is, okay, there won't be any tax benefits, and also it's like based on a disciplined way, 401k would be at a better place because obviously there's a bigger or a higher lock-in period and you won't be able to liquidate your portfolios that easily. Okay, there are also hardship withdrawals happening. That's something that we're going to talk about. And okay, how is your 401k constructed usually? So in 401k, actually, there are a lot of different options. You have mutual fund, stocks, bonds, and cash reserves, and so on. So my colleague Harshil is going to talk in detail about this. But before going to the construction of the 401k portfolio, one thing I wanted to highlight during this webinar was actually it's like people in US or people in America are actually treating the 401k as something like an emergency reserve or like something like a cash machine. So it's like one thing that has boosted the 401k growth story is automatic enrollment. Like 1-2 years back, if you wanted to participate in your 401k plan, there was a set of paperwork that you had to do and then get enrolled in your employer-sponsored 401k plan. But as of now, if you're joining an organization, there's an automatic enrollment. So this has actually swept more workers into 401k accounts, giving them some savings. And actually, this is the reason they are drawing on some emergency. So there's a record of 3.6% actually took withdrawals from this 401k accounts for the financial emergencies and so on, as per the Vanguard data. But on the other hand side, what you see is an average 401k account balances rose to 19% on a year-on-year, and the savings rates are also have been trending up. So what happens is it's like one thing is due to the auto enrollment, it's like people actually tapping in and they are participating in the 401k. But what happens is people don't have emergency reserve or something like a risk management backup. At that time, they are going and touching this 401k plan and they are actually hampering their retirement corpus. This is just an investment avenue that you need to set up for your retirement and for your golden years, not for your emergency reserve or something like a contingency reserve. So what I'm going to recommend you guys is, let's say it's like if you're already working in and if you don't have an emergency reserve in place, your 6 months of your expenses to 1 year of your expenses is something that you can focus on building as an emergency reserve, and you can park it under your cash savings balance, your NRA fixed deposits, or literally in money market securities. So that if there's any hardship withdrawal that comes in, you don't have to necessarily go and touch in or tap into your 401k accounts, and your emergency reserve would be there for you. So hence, it's like emergency reserve, building up an emergency reserve is one of the best important and priority thing that I would recommend you all to do in. And also it's like, let's say it's like one thing is what generally we see is in America or US, it's like the general savings account balance is too minimal. So at that time, mostly people actually lock in the entire money or corpus under 401k and so on. So hence, there is a need of some contingency reserve. So hence, setting up an emergency reserve is too important. So there's another data point that I wanted to share is, let's say you have some emergency and there's a hardship withdrawal and you want to withdraw from your 401k portfolio. So let's say there is a $10,000 is your requirement and you want to withdraw from your 401k portfolio. There's a 10% withdrawal penalty that IRS charges on your portfolio on whatever withdrawal that is. Let's say it's 10,000, 1,000 rupees is gone for the penalty. Apart from that, 20% is going to be whatever slab rate that's going to that's what you'll be falling in. It's going to be paid as a tax liability under that. So let's say 20% is a tax liability that you're falling under. 2,000 rupees is going to go for that. Apart from that, only $7,000 is what you'll be getting if you are putting a hardship withdrawal of $10,000. In that case, it's best of both worlds to have and set up an emergency reserve rather than going and touching up your going and touch up your 401k portfolio for any of the hardship withdrawals. So that's what I'm going to recommend you guys. So yeah, I'm going to pass it on to my colleague Harshil. So he's going to take on and briefly explain more about the investment options that are there in the 401k portfolio and so on.
I think before I go, there's a question. I am 35 years old, and consider I'm also considering to go back to India. Let us consider a situation that I want to withdraw my 401k and invest something there, or need the money for kids' education. There meaning I'm assuming that's in India.
Correct.
Everybody knows we have to pay 10% penalty for withdrawing before 60. What are the options we have to minimize paying tax during the withdrawal? Like withdrawing standard deduction amount every year after moving back to India. Do you have any comment?
Yeah, so in this case, it's like there is no specific like tax saving way or best way to minimize taxes, because as per the guidelines, this is specifically logged in for your 60. There's no specific liquidity factor in this. And even if you're withdrawing, let's say for your kids' education, you're shifting back to India, you're withdrawing certain corpus from that, 10% would be the penalty that's the 401k IRS is going to charge. Apart from that, let's say if you're in India, 30% of that is going to go in taxation. Let's say if you're going to withdraw 1 million, 30 to 40% of that is going to go in tax liability and the penalties. So in this case, what I am going to recommend is, let's say even if you're having a 401k portfolio, you can build a separate brokerage account and investment portfolio where you're going to contribute towards your kids' education and build good corpus for that specific goal. And it's like in this case, let's say even if you're shifting back to India, if it's not that necessary, you can still hold on to this 401k portfolio, because even after moving back to India, you won't be able to contribute towards this, but you still have an option to rebalance and regularly review your portfolio. So this can be a big part of your portfolio, and let's say 20 or 30% of your total net worth can be under US portfolio. So yeah, based on an asset allocation part, holding 401k till your retirement would be actually viable rather than paying 30 to 40% as taxes and penalties.
So basically your suggestion is to not touch it, and then obviously the contributions will not go into it. It's redirected that what you're anyway wanting to contribute into other asset classes, into other vehicles. But you also have to review and sort of rebalance. And I think at the end of the presentation also we can have this sort of Q&A where we are going to talk about when is it that you actually go out and start reviewing. And that's the most important thing for 401k. Right. So in terms of where your money is going, right, you're all bucketed in the 401k between aggressive, moderate, and conservative. Right. If you look at some data that has come out in the last couple of days regarding 401k, is that a lot of Americans are now opting to save. And together with what you are contributing along with your employer's contribution, it's about 12% of your savings. Right? That's going up, and it's a lot of people have come into that system of saving and have seen that sort of merit. But you are all bucketed into three sort of baskets: aggressive, moderate, and conservative. Mind you, all your money just goes into equity, right? So when we were doing the study to say that okay, people are investing within their for their 401k, and it all goes into these particular baskets, and there's automatic rebalance, right? It's target retirement date, target maturity date that they follow, where over a period of time you would see your asset, irrespective of whether it makes sense in the market for you to shift out of one asset class to the other asset class, irrespective of whether it makes sense or not, just because you are reaching that particular age, automatically it would get shifted out. It's not a tailor-made solution. It's actually a one-size-fit-all, where you're sort of forced to go through that fitting process, right? But what might work for one investor doesn't actually work for the other investor. It depends on their needs. It depends on their goals. So you are again put into this basket of aggressive, moderate, and conservative, right? Vinayak, you can go on to the next slide. Yeah, so like I was saying, target-dated funds. Like so, everybody has this target of 20, 40, 20. There are various options for you to choose from, and one thing is that it is too conservative, right? If you see how much you've been able to grow, and if you do that study, it might not be very high. It doesn't beat your inflation there, right? It is costly, and it's not at all customized to every investor out there, right? There's no tailor-made sort of solution that's there. right? But it's all one size fit all, right? And that's one of the biggest cons when we saw money that is being plowed into 401ks, right? Your target dated funds, right? But on the other hand, it's a brilliant strategy. It's very simple. It does the diversification on its own, and the products that they have to offer also are of very good quality. It's all going into the market only, right? It's all going within the top 1,000. So that aspect of creating a product that can help you become consistent in your saving, that can help you become disciplined as a saver, and invoke that sort of patience in you of set it and forget it. That's a brilliant strategy. The only thing is, it's not tailor made. It's not tailor made for you. And but we can get to the end of it, and how to make it tailor made for you depends on you. So we can have that sort of review with you at the end of the presentation, and then you can get in touch with us. But keep in mind that it's not tailor made, but it's a brilliant strategy, right? Okay, so the various options that will be available to you on the mutual fund side, there is a bit of over diversification that happens here. That's where you need to sort of go out and control, right? You have blue chips, you have growth, you have balance, you have a lot of categories, and it's very confusing for an investor there. You need to keep things simple, right? You can't have a simple product that's doing complex stuff, right? So you will have avenues in which your money is going to that's not working, right? So for example, this might not be the right time to take a longer duration sort of an approach. A shorter duration might work. On the debt side is because the yields have sort of spiked up, right? That's a very good option for you to take up, but you might be forced to take up other stuff and other opportunities within that 401k basket that is being offered to you, right? Then you have an over concentration into blue chips, into growth funds, right? They are all plowed into just the top 7, right? And that's not something that you need to do. Following the herd is not actually going to lead into you building that sort of wealth, right? There is the allocation that goes into emerging market is somewhat lower, but today emerging markets are such that they are the only investment avenues that is offering you more than 8% GDP growth. Okay, these are countries like India where you can take advantage of this sort of growth wave that is coming up here. So there is an over concentration on larger players there, and within that, it's just within the top 7, top 8, and under allocation that goes into emerging market funds, right? And a forced allocation, if I can be candid, towards small and mid cap, right? Because there is no sort of, unless and until there is a cut in rates, and unless and until there is good amount of opportunity that is available, you will always have those small and mid trading at deep discount to your larger players there, because the growth is available there, right, on the large player side, right? So you do get a lot of options, and you do get a lot of confusion, but my suggestion is that you should keep things extremely simple. And we have reviewed each and every broker's offerings to show that yes, these are things that investors can do, and we have been able to support our 401k investors by making sure that they are invested at the right place at the right time. Vinayak, I think you can, yeah. So this is what I was talking to you about. So 64% of all of that that goes into mutual funds are equity mutual funds. Like you already saw this sort of data that it's majorly going into equity markets. This is slightly dated data, but nothing changes. It's just that the pool becomes a lot more bigger. But this number of money going into equity mutual funds, and within equity mutual funds going more into your mega caps within your top 10, your top 20, that's where most of the money really goes. So all money is chasing performance. All money is not working smart. All money is just following the herd, right? And this is where we come in as advisors to be confident, to make sure that you are in the right place, right, at the right time, right? Vinayak, you can go forward. Yeah, I think the average allocation that goes into it, everything is equity oriented. There's no proper balance when it comes to holistically building wealth, right? You can get opportunities on emerging debt as well. So today in India, duration that is longer duration is somewhere around 7.5%, right? But if you look at that case in the US, that's not the case there. So you will always get these opportunities in a developed nation where you have access to papers and products in developing nations, right? So that is one big advantage of the 401k, is that it's borderless. You can invest anywhere and everywhere, right? But most money goes into the one particular asset class and it goes into the same category. That's the only problem that there is. Again, in terms of valuation, where is your money going? Your money is going to the most expensive parts of the market, right? So today, if you say Nvidia keeps on hitting newer highs, AI is entering into a bubble category. It's not that investors and savers in the US have not seen this, but yes, they put a blind eye to it. But as investors and savers, you need to be cautious. And today, I think there is a good amount of merit in being cautious. I think my slide is stuck.
It's on understanding rebalancing.
Yeah. Now I think Vinayak, you can come in.
Yeah, okay. So it's like more about understanding the rebalancing would be, it's like, let's say it's like if you had a investment allocation plan and you had set it right. So more or less, it's like it won't be like regularly like sector rotation or continuously churning your portfolio. It would be just tuning in your portfolio on a regular basis. That doesn't mean like buy, sell, or regularly like do the switch. It would be just buy at a correct valuation, at a correct price, and a correct ETF or correct mutual fund is what I would say. Apart from that, before investing in any instrument, it is very important to review your risk tolerance and risk capacity. Because it's like what we generally see is, it's like, let's say if an investor has started contributing towards 401k, and if they think, okay, they have not made enough good returns and so on, by default, what thinking that comes is we should need to like allocate 80 to 90% of the entire portfolio into small caps. So they associate higher the risk, higher the returns. That's not actually the correct case or so. You have to review and recheck what is your risk tolerance, what is your risk capacity. And based on the market valuations and so, as Harshil said, we'll be selecting all the investment avenues that are there under your portfolio. So it's like, okay, what do you do when you retire early or are making a shift? So it's like job hopping is common nowadays, but it can lead to actually confusion in many retirement accounts. So instead, think about moving an old 401k into a rollover IRA, individual retirement account. So let's say even if you're retiring or if you're finding a new, let's say even if you're retiring, you'll be able to rebalance the IRA account with vast number of allocation options that are there in the market. Or let's say if you're joining a new job, you will be able to port your existing 401k plan to a newer 401k plan. So actually under the Q&A, someone has asked a query about why there's a 30 to 40% of the tax implication that might come in. So as of now, 10% is a penalty that would be charged on your portfolio on whatever you're withdrawing based on hardship withdrawals. So let's say apart from that, there would be federal taxes, federal state taxes. And that's actually at the level of 20 to 30%. And it actually differs from person to person based on a slab rate and so on. So as a rough estimate, 30 to 40% of the total portfolio might go just for the tax liability and penalty if you're withdrawing it before you're 60 years of your age. So that was a basic approximate amount that we had initially said. So it's like, okay, what are the ways and steps actually to consistently build and increase your 401k? So one thing is, if you're joining or if you're just in college and if you're planning to join a workforce in next 1 year, 2 years and so on, one recommendation is going to be start your 401k from the earliest stage as you can. One thing is you get best investment avenues that are there in the entire global portfolios and so on. And apart from that, best way is like tax saving. It's like you can reduce your tax liability now or in future, depending on the whatever slab rate that you're following. Apart from that, one thing that I would like you all to focus on would be getting the full employer match. So you can like reach out to your HR team and finance team and figure out what is the best possible way to max out your 401k contributions and yeah, make the most of it. And some organizations do have like certain like vesting period. Let's say they have to work for 1 year or 2 years. Post that, they would get the 401k investment option. But usually what we have seen generally is, as of now, there is automatically enrollment plan. So it's like most of the organization don't have certain vesting period. So it's like, okay, if there is a vesting period, stay until you're vested and yeah, invest under the 401k plan. And also it's like what we would recommend is bare minimum, rebalance your portfolio at least once a year, because you need to tune in and see it's like if the allocation to certain sector, certain portfolio, certain allocation has been increased rather than what you had said earlier. You need to just fine tune it. And actually, it's like, let's say if you are shifting your jobs on a regular basis and so on, you need to just keep a track of your existing 401k plans from previous employers. And actually, what I would recommend is try to shift it into an individual retirement account or roll over it to a traditional or a Roth IRA account is what I would recommend. And one thing is, it's like, okay, we do contribute towards a 401k plan and so on. But how often do we quarterly review or see the statements and our holdings that we're investing in? So this is one thing that I would recommend at least once a year or at least quarterly. Just check or go through whatever investments that you have done so far and so on. And if you need help, surely ask for it. There are a lot of financial advisors that have expertise in this area and will help you in reviewing and rebalancing your portfolio on a regular basis. So yeah, again, it's like staying on top of your 401k company match. Understand your company rules and regulations. Speak to your HR and learn about any vesting period or vesting schedule that your company may have. Once these three things are sorted out, you can make most of it and do the maximum match of the employer and get the free contributions that are there. So apart from that, more about iThought and actually our PMS products and so on, I would request Harshil to come and give a brief about the same. Post that, we'll open the space for questions.
See, we had started iThought back in 2013. So I think it's a good 10, 11 years since we've been in existence. But it was started by our founder, Sham Shekhar, and he has had a 30-year investing career. And his endeavor was always that he wants to build, help people build, their wealth. And that does not have to be anything, in the complex route, but it has to be extremely simple. And with that endeavor, that led into our mutual fund business, our MFD and the RIA business, and then it led into planning. And Vinayak is part of the planning, and that again led us into PMS, that is portfolio management services. Right? So today, as a house, this data is slightly dated, but we are managing more than 3,500 crores across all verticals, and we are serving more than 2,500 families. Right, we are a fundamentally research and research-backed organization where we are contrarian in nature, but we also are value-oriented. So value-oriented, that doesn't mean that we will only buy something that's cheap, but we will buy something that makes sense, right? And I think you can go on to the next slide. We are a Chennai-based organization. Our investment philosophy is very simple. We are bottom up. We do focus a lot on risk management. Risk management doesn't mean that we don't take risk. We of course take risk. You have to take on risk, but where do we take on risk is what matters. And we don't like to take on risk where it's more consensus. We do non-consensus investing. And of course, anybody who partners with us has we like to partner with investors who have a 10-year plus sort of horizon. I think that's about it, right? I think we can open the floor for Q&A. Yeah, you can just have the slide for the team open, and I think we can go on to Q&A. Yeah, so this is the team. If you see, Sham Shekhar is right up on top. He's our CIO and he's the fund manager for our flagship FlexiCap product, co-fund manager in the True Blue, which is more the large cap product, the small cap product, and he's also the fund manager for the multi-asset strategy. That is the resident multi-asset strategy is Sphere and non-resident is Neo. Right. So he is the fund manager and he does play a vital role in mentoring us and making sure that we are on the right track. Right. If you see the fund management team, our head of research is also the co-fund manager of the large cap fund. Rohit and Rajat are fund managers of the small cap fund, and Niranjan, who is our head of investment strategy, is part of the multi-asset fund, that is Sphere and Neo both. And we have a strong roster of research and strategy, and of course Vinayak, who's part of this presentation, is also on the financial planning team, but he doesn't come over onto the PMS side, but he is a core member of the planning team, along with one more. Nakul, he's not on this, but I'm sure he's somewhere listening.
Yeah, he is
So now I
actually in the
think
session.
I think we can open the floor for Q&A now.
So actually, there's a question about 401k versus Roth IRA from a tax standpoint. Which one would make more sense? So it's like it's going to be again different from person to person based on the tax liability and so on. But what I would prefer as a just as an investor, not as an advisor, is Roth IRA account. It's gonna be after with after tax dollars, whatever contributions I'm making, and during my retirement, I won't be liable for any taxes. That's what I would actually prefer as an.
Vinayak, you can put the slide for our number, and if we miss out any question or there are questions that come to the participants' mind later on, they can at least reach out to us. So do reach out to us, send us a hi, and we will put you onto our content team and communication team as well, where you will get regular updates about our products, about particularly 401k webinars, because I feel that that's a lot more helpful. Right now we are doing more broad based, but as and when we start getting in more and more queries, more and more questions, we will take on specific topic oriented session.
Right. Does a 401k make sense for someone who is having his their own business? So it's like actually one thing you have to know is it's like 401k is an employer sponsored program. So if you're having a business, it's like you are supposed to be the one who's providing to your employees like a 401k or a retirement plan. In that case, for a businessman, what they can try to do is an individual retirement account or a health savings account. So in that individual retirement account also, it's like based on the broker, they would have a broad allocation or investment options that they can invest in and they can participate in. So if you are a business owner, it's actually worth it to invest in an individual retirement account. It's similar to a 401k portfolio. Harshil, there's a query about Spear Neo, actually Neo.
Okay, particularly Neo. So Neo is for NRIs, and it is the same strategy as our resident multi-asset strategy. So the multi-asset strategy is very simple. It's a flexible mandate, which means that it can go from 0 to 100 in any asset class. Okay, so let's say if we want to take a call on equity, we can go from 0 to 100 in direct stocks, in mutual funds, in ETFs, whatever. But for Neo, we will not be able to take too much of mutual funds, but we can take that call for within equity wherever there is opportunity, right? We can go from 0 to 100, be it debt, be it precious metals, or be it global investments that we have access to from the Indian market, right? It is a multi-asset, dynamic multi-asset, so there's no cap, right? It's very, very flexible. That's the difference. And if you compare us to any other multi-asset fund here in India, they would have specific mandates. Here it's flexible, it's completely open, right? The fees is 1.5%, and it's fixed, there's flat, there's no profit sharing, and there is no exit load also, right? So you can enter whenever you want to, you can exit whenever you want to, right? Across all our products for the PMS, we don't run a model portfolio, which means that let's say today you decide, say I want to do Neo, your portfolio will be completely different from somebody's portfolio who got built 6 or 7 months back, right? Because opportunities are changing, and so your portfolio will be completely different from the other portfolios, right? The PMS also takes up SIPs, so it's like a mutual fund only, where the more you participate, the more we are able to scale up on our existing ideas and add newer and newer ideas, right? So that's sort of our offering on the PMS side, right? Right now we are overweight on equity, but we have now added arbitrage. We are looking to add more on the debt side, proxy side, and we are overweight also on the precious metal side, along with some investments in global. Right. So our day one deployment today is somewhere around 45 to 50%. So nothing goes in on day one. We take a staggered approach in building positions. It might take us 6 to 7 months, depending on the market, to sort of deploy that entire money. Okay. So since it's not a model portfolio, we do a staggered in and a staggered out.
So next question I'll take is how ithought will play his role in 401k, which is based in US, and funds in 401k is limited based on what employer provides. So let's say it's like as of now, how we help out in the 401k portfolio review would be the financial planning service. So 401k portfolio review is going to be a complementary service to our existing financial planning service. So in this case, what's going to happen is, let's say it's like so you have to just share as your existing holdings under your 401k portfolio, and what are the investment allocations there under the employer sponsored services. Let's say if it's actually good and at par, and it's like we are having a good conviction on the same, you can keep on continuing on the same. Apart from that, let's say it's like if your employer, there's a limited option, or the allocation is very limited or less in the employer sponsored services, we would recommend you set up a separate investment brokerage account and so on. And in that, we'll be able to help you out in providing the allocation based on your risk capacity and based on your financial goal. So that's what we'll do. We can set up an IRA account or an individual brokerage account. So that's how we'll be able to help you out in rebalancing the portfolio.
I think execution we will not be able to take over. You will have to take over the execution part, right? But whatever from our side is there, we will give you timely updates saying yes, you can do this, you can do that. These are options that are available to you based on whatever your account is sort of set up as, right? But execution we will not take up, right? Everything else that goes behind research, that everything that is on the research side, that we are doing in-house, and you will keep getting timely updates from our side, right? And one-on-one conversations also can take place regarding whether you've been able to execute it. If you've not been able to execute it, we've had cases in which our sort of investor has lost out on that execution part, so we will have to do something else for you. What's the minimum investment to start with? The minimum investment is 50 lakhs INR. This is SEBI mandated. So since all the PMS comes under SEBI's purview, regulation says that minimum is 50 lakhs.
So there's actually a question on Q&A about what is the asset allocation plan for a 55-year-old?
It depends on your goal. See, if the next retirement is your goal, how long up until you retire, right? That's one. Second is how much you are currently saving and how much you would require after you choose to say retirement. After you say, no, I don't want to do any job, nothing, I don't want to do anything. How much will you need on a monthly basis and how long can you survive on that? So it depends on your goal. So we never choose to do a fixed asset allocation model for anybody because everybody's needs are different. For some, it makes sense to go overweight on the debt side because they don't have the appetite to take up that sort of risk on equity. But it depends on your risk appetite. It depends on what your goal is. We never have a fixed asset allocation mandate for anybody who comes on board with us. That's for PMS. But do you have other products which require less than 50 lakhs? Less than 50 lakhs, you can do mutual fund distribution here with us. That's another arm. That's more on the mutual fund side, more mutual fund distribution side. There's no minimum amount in that. There's no fees also on that. We do regular mutual funds here in India, and whatever commissions we get straight from the AMC. So you don't have to pay anything to us. And the minimum investment is not 50 lakhs. You can do whatever you want to do with that.
I guess we can wind up, and it's like if there's any questions or queries, you can just
we'll keep the floor open for another 3 to 4 minutes, and then
we'll wind up.
Then we can sort of, if there's questions that we missed out on, just send us a hi on this number with whatever question or whatever query you have, and somebody from the team will definitely get in touch with you.
Because
or you have a specific query. If you have a specific query regarding something that you want us to work on, we can have a one-on-one discussion also with you on it.
Can you review my active and current 401k plan and give your opinion? So you can reach out to us. It's like I'll drop our email IDs in the chat box. You can just reach out to us and we'll do the needful. And we can do something productive together.
Where are you seeing these questions?
Actually, there's a Q&A symbol right next to chat.
Oh, I think I missed that out. Okay.
Yeah.
I'm seeing the chat box. Perfect. I don't think that we're getting any more questions.
Yeah, I guess we can like wind it up.
Yeah,
because
thank you all for joining in. On a Saturday. I really appreciate your time, and do get in touch with us if you have any other questions. We are very happy to help you out, be it on the mutual fund side, be it on the PMS side, be it on your 401ks outside, right, or any other investments also that you need some sort of guidance and help on. We are here to help you out. And thank you so much. Cheers. Have a great weekend ahead.
Thank you all for joining in today. Yes.